Have you ever wondered what exactly happened back in 2008? One minute, everything seemed fine, and the next, the global economy was on the brink of collapse. It's a complex story, but let's break down the 2008 financial crisis in a way that actually makes sense. Steek wheat may, and I promise you'll get it. It all starts with something that sounds pretty safe. A home. For decades, owning a home was the American dream. And to get a home, you need a mortgage. Traditionally, banks were pretty careful about who they gave mortgages to. You needed a good job, a solid credit history, and a decent down payment. These were called prime mortgages. Simple enough, right? But in the early 2000s, things started to change. Interest rates were incredibly low, which meant borrowing money was cheap. Wall Street, always looking for new ways to make a profit, saw a golden opportunity in the housing market. They thought, why only lend to people with perfect credit? Let's open the floodgates. This led to the rise of subprime mortgages. These were loans given to people with lower credit scores and unstable incomes, people who wouldn't normally qualify. The lenders weren't too worried, though. For one, they were charging much higher interest rates on these loans to compensate for the risk. And second, housing prices were going up and up. The thinking was, even if a borrower couldn't pay, the bank could just take the house and sell it for a profit. What could possibly go wrong? Here's where it gets really complicated, but also fascinating. The banks didn't want to just hold on to these thousands of mortgages. That's a lot of risk tied up in one place. So they decided to package them up and sell them. Imagine making a giant financial smoothie. You take thousands of different mortgages, good, some okay, and a lot of those risky subprime ones, and you blend them all together. This financial smoothie was called a mortgage-backed security, or MBS. Wall Street investment banks would buy these mortgages from the original lenders, bundle them into an MBS, and then sell slices of it to investors all over the world, pension funds, foreign governments, other banks, you name it. To make these packages even more attractive, they brought in the credit rating agencies, companies whose job is to rate how safe an investment is, for a variety of reasons, including a major conflict of interest. These agencies gave many of these mortgage-backed securities a AAA rating. That's the highest, safest rating possible. The same rating given to super stable U.S. government bonds. This AAA stamp of approval was like a magic wand. It made these risky packages look like solid gold. Investors from all corners of the globe rushed to buy them, eager for the high returns they promised. This created a massive, interconnected chain. The original lenders kept making more and more risky loans because they knew they could immediately sell them to the investment banks. The investment banks kept creating more and more MBSs because investors couldn't get enough of them. And all of this was built on one crucial assumption, that house prices would keep rising forever. For a while, the party raged on. The housing market was booming. People were buying homes they couldn't afford, sometimes with no money down. Some were even flipping houses, buying them and selling them a few months later for a huge profit. It seemed like a win-win for everyone. Lenders were making fees, Wall Street was making billions, and regular people were getting into homes. The economy was humming, but every bubble has to pop. By 2006 and 2007, the first signs of trouble appeared. Many of those subprime mortgages had adjustable interest rates. After a few years, the low introductory rate would disappear, and the monthly payments would suddenly shoot up, often doubling or tripling. At the same time, the housing market started to cool off. Prices stopped rising in many areas, began to fall. Now, the whole system started to unravel. People who couldn't afford their new, higher mortgage payments couldn't just sell their house to pay off the loan, because the house was now worth less than what they owed. This is called being underwater. Defaults and foreclosures started to skyrocket. Remember those mortgage-backed securities? The financial smoothies. Suddenly, they were filled with toxic assets, mortgages that were not being paid. The value of these AAA-rated securities plummeted. The investors who owned them, banks, pension funds, everyone were sitting on massive, catastrophic losses. No one knew who was holding the bad debt. The trust that holds the entire financial system together evaporated overnight. Banks stopped lending to each other because they were afraid the other bank might go bankrupt the next day. This credit freeze was like cutting off the oxygen to the economy. Businesses couldn't get loans to pay their employees or buy supplies. The entire system ground to a halt. Then came the giants. In March 2008, the investment bank Bear Stearns, one of the biggest players on Wall Street, collapsed and had to be sold for pennies on the dollar in a rescue deal. The market was shocked, but many hoped it was a one-off event. They were wrong. The real earthquake hit in September 2008. Lehman Brothers, a 158-year-old investment bank, declared bankruptcy. This was unthinkable. It sent shockwaves through the global financial system. The Dow Jones Industrial Average had its biggest one-day point drop in history. AIG, the world's largest insurance company, was also on the verge of collapse because it had insured trillions of dollars worth of these toxic assets. The U.S. government realized it was facing a complete meltdown. To prevent a full-blown depression, the government stepped in with a massive bailout. The controversial $700 billion Troubled Asset Relief Program, or TARP, was created to buy up toxic assets and inject capital directly into the banks to keep them from failing. The Federal Reserve also took unprecedented actions, lowering interest rates to near zero and pumping trillions of dollars into the economy to get credit flowing again. The immediate crisis was stopped, but the fallout was immense. The stock market crash wiped out trillions of dollars in retirement savings. Millions of people lost their jobs as the country plunged into the worst recession since the Great Depression. The housing market collapse left millions of families homeless. The 2008 crisis was a painful lesson in how greed, a lack of regulation, and a complex, interconnected financial system can create a perfect storm. It showed how problems in one part of the economy, like the U.S. housing market, could trigger a global catastrophe. In the aftermath, new regulations like the Dodd-Frank Act were put in place to try to prevent something like this from ever happening again. And that, in a nutshell, is the story of the 2008 financial crisis. It's a tale of how the American dream of homeownership got twisted into a global financial nightmare. It's a reminder that when things seem too good to be true, they usually are. Thanks so much for watching. Understanding these big events helps us make better sense of the world we live in today. If you found this video helpful, please hit that like button and subscribe for more deep dives into complex topics. And let me know in the comments what you'd like to see broken down next. See you in the next video.